Excel accounting practice problem, receive payment form. Get ready because we're about to excel with Excel. Here we are in our Excel worksheet. If you have access to the Excel worksheet, would like to follow along, 2 tabs down below, example practice, example tab in essence being an answer key. Let's take a look at it now. In prior presentations, we put this worksheet together from a blank sheet. Now we're going to be using it to analyze a transaction related to a receipt of a payment. Or in other words, we're imagining a situation where we had done work in the past issuing an invoice, increasing the accounts receivable, and now we're going to record the receipt of the payment from the customer. If we were to compare this to accounting software, we might input a form such as this, customer payment type of form, which would follow along after we have the invoice. The invoice would be the transaction that would be increasing the accounts receivable, and then sales, possibly then having inventory involved. However, we're not focused on the inventory at this point in time because we're really just focused on the accounts receivable, tracking the accounts receivable, now thinking about when we got payment on it, the customer then being referenced for the payment that we have then received. We would then be referencing and tying to the invoice in, say, accounting software, and this form then would create the journal entry of decreasing the accounts receivable, applying then the amount usually to either the checking account, going directly into the checking account, or we might have some kind of clearing account that it goes into first. And that clearing account is something that from an accounting standpoint, when you're learning just debits and credits, often isn't included. And that's an added step that you need to think about with an actual accounting software, because you need to think about the bank reconciliation process. So we'll talk about that a little bit more as we go as well. So that's what we'll record the transactions up top. We will record an invoice type of transaction and then the receipt of the payment, doing 2 formats. One in more of a traditional accounting setup where we're going to receive the payment and deposit it directly into cash. And the second being that we're going to deposit into undeposited funds, which you might use in accounting software, and we'll talk a little bit more about why that might be the case. So we're going to go to the practice tab then and enter this in. First, we're going to imagine we're entering an invoice for service that was done. We're not going to be dealing with inventory at this point in time because we really just want to get the accounts receivable on the books. So we're going to say then that, let's say on 3/15, we issued an invoice. Typically what would happen there is receivables would go up. We would increase the accounts receivable. We're going to debit that to increase it. We're going to say it's for $1,600. The other side would be going to some type of sales account. So we'll pick up the sales account down below. Sales, notice it's indented here, alignment indent. And the sales goes up with a credit, which I'm going to put in D3 as negative of the cell above it. So there is our debit and the credit for the invoice. No inventory are we going to be dealing with this particular transaction. Let's record this item now. Accounts receivable. Here's the accounts receivable account. It's going to be going up. I'm in cell H6, going to say equals. Scroll on over to that 1,600, increasing 2,000 up by 1,600 to 3,600. The second half then going to the sales item. That's down below. We're out of balance now by the 1,600. We're in sales. Sales is a credit. That's why it's a negative number. The negative numbers representing credits. It's going to go up in the credit direction. That will increase then the net income down below as well. Equals, pointing to that 1,600. And it goes up from 200,000 up in the credit direction to 201,600. The net income, this not being a loss, but income, the brackets representing credits, 24,710, going up by the 1,600 to the 26,310. Let's go ahead and post this now to the general ledger. So we're going to go on over to the GL, looking for accounts receivable, the third account on the trial balance, third account on the GL then as well. That'll be down here in, let's delete this item down here. It's going to be down here in 017. 017, we're going to say 315. And then in P17, going to say equals. Hold down the left arrow till I hit the wall. Scrolling back up, and we're going to be picking up that 1,600 and enter. So it went up from 2,000 up by 1,600 to 3,600. That 3,600 then is on the trial balance as well. We're out of balance on the general ledger, by the 1,600 until we record the other side going to sales. That's going to be the first income statement account. It's in order in the GL. So I'm going to go to the right till we find it. Assets in green, liabilities in orange, equity dark blue, and then the sales in the lighter blue. I'm in cell AI5, 315. We're now in cell AJ5. I'm going to say equals. Scroll all the way to the left until I hit the wall, and then pick up that 1,600 going to the sales account, going from 200,000 up by the 1,600 in the credit direction, doing the same thing to it, increasing it to the 201,600. That 201,600 also then being, of course, on the trial balance, as we saw here, back in balance up top on the GL, given the green zeros. Okay, so that's going to be the invoices in place. We also need to record the accounts receivable in the subsidiary ledger. So the subsidiary ledger should add up to this same amount, but it's got to be broken out by customer. That's all the way to the right. So we're looking at accounts receivable subsidiary ledger. I'm going to put that in customer 4 here. And so on 315, we're in cell BD17 equals, holding the left arrow down all the way till we hit the wall. We're looking for the debit to the accounts receivable. So there it is, the debit of the 1.6, enter. So there it is, and we have then, you could just type in there equals D2 if you so choose, increasing the balance for customer 4 by the 1,600 to the 1,600 for customers now. Then add up to that 3,600, breaking out the accounts receivable balance by who owes us the money. It is in balance to the trial balance and GL, given the 0 here, but let's double check that. 3,600 going all the way back to the left is also, of course, the amount here in the receivables. So now we're going to say the receive payment type of form. So now we're going to connect the receive payment form to this transaction. In practice, when you're tracking this information, you want to tie basically the receive payment, as you can see here, to, in essence, that particular invoice. And that allows you, when you drill down on the invoice, to see that that's connected to a receive payment and therefore paid off. And so the journal entry that would be supporting this receive payment, if we then took that money and deposited it directly into the checking account we are imagining here, instead of going to undeposited funds first, which is traditionally how you see it in normal accounting when you just learn accounting, because we usually just work with cash and not undeposited funds and thinking about the bank reconciliation. And then we'll add in the added wrinkle of undeposited funds. So first, let's just imagine we got paid now. And we're going to say, okay, that happened on 3/25. We will imagine we're getting money, and I'm going to put it directly into the checking account. So we're going to say we got it. We're going to put it directly into the checking account. Now, why wouldn't I put it directly into the checking account? Sometimes if I got cash, for example, and I got multiple different amounts of cash, and I'm going to deposit it into the bank account at one time, then my goal is to put it into my books in the same format that it's going to go into the bank account. So that's why I might have a two-step process. If, on the other hand, I'm getting paid for a particular invoice and it's going directly into my bank account for that particular amount, same amount, then I can put it directly into my checking account. And when I reconcile my books to the bank account, I shouldn't have a problem, and that'll work fine. So that's what we'll do here. We're going to say, all right, that's going to be the 1,600. And then the other side is going to go to the accounts receivable now going down. Going to indent that, alignment indent. There's the debit and the credit. So if we were to post this, we're going to say, okay, we debited the checking account. The checking account would be increasing. Accounts that are assets have debit balances. They typically go up with a debit. So we're going to say this will be equal to that 1,600, increasing the 100,000 by 1,600 to 101,600. Then the accounts receivable is going back down. There's something in accounts receivable. So I'm going to double click on it, go to the end of my formula, say plus that negative number or the credit. So now I have debited and credited it. That means the difference or change goes back down to 0. So we got the 2,000 back to the 2,000 here. Notice there's no impact on the income statement for that second transaction, even though that's the point in time that we got the cash, because we recorded the income when we did the work, which on an accrual basis would make sense because that's when we invoiced the client And usually the invoice will be closer to the point in time that we actually did the work, which is when we usually want to record the revenue. So now we're going to record that to the general ledger. Here's the checking account. Let's go on over to the GL, general ledger, on 325. We're going to say this is going to go up by the 1,600. So that goes up from 100,000 by 1,600 to 1,016. That 1,016 matches the trial balance. We're now out of balance on the GL by the 1,006. Accounts receivable, third account on the trial balance. Therefore, also third account on the GL, the general ledger. There it is. So this happened on 325, we're saying. We're in cell P18. I'm going to say equals. Hold the left arrow till we hit the wall. And then scroll back up. And we're picking up that 1,600. So this should be the normal trend with the accounts receivable. You see it started at 2,000. It went up with an invoice, in this case, to 3,006. And then it's going to go down with a received payment when the customer pays us off. That 2,000 then also now on the trial balance. We also need to do that, however, with the subsidiary ledger to show that which customer paid us off. So we're going to go all the way to the right to the subsidiary ledger, the accounts receivable subsidiary ledger being subsidiary because it needs to be adding up to the primary account of the accounts receivable, 325. So we are in cell BD18 equals, going all the way to the left till we hit the wall, and then scrolling back up, and we're picking up that accounts receivable in D6. If I double click on that, there it is on D6 right there. So then this is the normal trend we would see. It would be, and you would see this trend even more clearly in the subsidiary ledger, meaning it goes up with an invoice. And if you're looking at like QuickBooks data, it would show you that the type of form would generally be an invoice, and then it would go down with a received payment type of form when we got paid. And you should be able to go through and kind of tick and tie these off. Those are the only kind of transactions typically that'll be there in this accounts receivable ledgers and subledgers. The total now of our 4 customers back to 2,000. That matches the trial balance indicated by the green 0, but let's double check it. Going on back over, does it match? It does indeed. Let's do it again, but this time on this second half, when we get the payment, we're going to put it into undeposited funds, imagining that we've got like cash, let's say, and we're going to get cash from multiple different people, and therefore we want to put it into undeposited funds and then later roll it from undeposited funds into the checking account, grouping the deposits in the same format in our accounting system as they will appear on the bank statement so that we can reconcile our books to the bank as easily as possible. So same starting point. We're going to make another invoice. Let's say it's on 410. So same invoice. We're not going to be dealing with inventory because we're focused on the accounts receivable. So same service type of invoice. We're going to say this time it was 1,400 just to make things different, change things up. So same starting point. We're going to go over here to cell H6. Now I'm going to, instead of double clicking, I'm going to select F2 on the keyboard, which is a lot faster if you want to start using that, just to show you. And then you could say plus. And then when I use the arrows without using the mouse, I could say F2 on the keyboard. And that allows me to use the arrows. So that actually is a lot faster. It's more geeky, which is, that's what we're going for here. That's the goal. And so now we got those two things that happened now we increased it by that 1,400, basically 2,000 plus 1,400 to 3,004. Then down below in the sales area, I'm going to do the same thing. Something's in it, F2 on the keyboard, plus, and then I have to hit F2 so that I can move the mouse again and not have it move within the cell. Then we're going to pick up that 1,400. So that brings it up. So we got a total increase now between the two sales items of the 3,000, bringing it up to 203,000. We're back in balance with the green zeros. It brought net income up in the credit direction from 24,710 by 3,000 to 27,710. Let's record this then to our general ledger. Accounts receivable is our third account on the GL. Third account on the GL. There it is. We're on 310. So we're in P19 equals, going left till we hit the wall, scrolling up to that 1,400. So here we had it, it went 2,000, and then it went up with like an invoice for work we did and billed the client or invoiced the client to 3,600. Then we got paid, it went back down to 2,000. That's a received payment type of form. Then we invoiced again, another kind of invoice, or we did work and charged the client, invoicing them 3,400. That 3,400 should then be what is on the trial balance. Our general ledger is out of balance till we record the other side, sales, which is our first income account. Going to the right till we find it. Green assets, orange liabilities, dark blue is going to be the equity sales in AI6. AI6 on 410. And now we're in AJ6. We're going to say equals. Hold down the left arrow until we hit the wall. And then we're going to pick up that 1,400 and enter. I keep on running my head into the wall here. This is not healthy. 200,000 plus the 1,600, that's the 2,016, plus the 1,004 is the 203. That 203 should be also what's on the trial balance over here. And it is indeed. We're back in zeros on the GL, so everything's tying out. We also need to go to the subsidiary ledger because we hit the accounts receivable again. So we got to know who owes us the money so we can call them and hassle them daily until they pay us what they owe us. So all the way to the right. Let's say this happened for the customer 1 this time on 4/15. They already owe us $1,000. Whatever. AZ5. We shouldn't sell them anything else till they pay us, I feel like. So there's the 1,400. So now it increased from 1,000 by 1,400 to 2,400. Adding up then all of the 4 customers that owe us money now, except that last one doesn't owe us any money anymore. But that adds up to the 3,400. We should be matching the trial balance indicated by the green 0. Let's check it out. 3,400, is that what's on the TB? It is. Okay, so then we got the received payment. We're going to do the same thing as we did here, because now we have this receivable amount. We're imagining they're going to pay us. But this time, we're going to say, hey, look, they're going to pay us with cash or something like that. I don't want to put it directly into the checking account, because if I put it directly into the checking account, then it's not going to match up on my books to the groupings that's actually going to go into the bank account, because I'm going to group these deposits differently when I go to the actual bank and deposit them into the bank. And this is something, again, in normal accounting, like if you were to use debits and credits, you wouldn't have these 2 accounts. Oftentimes, they would just call it cash. And therefore, you don't have this issue of, well, am I holding on to the cash? Or is it a check? Or do I have to group? But in practice, you always want to be thinking, once it hits the checking account, is it hitting the checking account in the same format as the bank will be hitting the checking account? Because that's my huge internal control called the bank reconciliation. So if I'm going to be depositing differently than they're going to be hitting the checking account with, then I want to use some kind of method to allow my bookkeeping system to deposit in the same grouping that's going to be on the bank. That could happen, and it's most likely to be a problem if you get like cash payments and then you deposit in a group amount, or if you get payments from like credit cards and the credit card company, for example, is grouping your deposits together in some grouping format and then putting it to your checking account, and you're trying to track the actual customers, then you got to come up with some kind of system which might include another account, which you might call a clearing account called undeposited funds, putting it into undeposited funds so that you can figure out the grouping of the funds as they go into the checking account, then make the checking account deposit in our books in the same format as will be on the bank statement, so that you can then reconcile our books to the bank statement, the reconciliation being a huge internal control and something that we want to make sure to do. In the software down below, that's the default setting. So if you weren't to make any changes, the QuickBooks would deposit it into this undeposited funds. Now just realize that undeposited funds is partially because of this reason, because no one really learns it in normal accounting because they just call it cash up top, is a thing that gets messed up a lot. People don't understand what that is and why you would use it and so on, and then it causes problems. So you want to get an understanding. There is a purpose for it. If it's necessary to do, you got to know when it would be necessary and when it wouldn't be. So we're going to do, it would be the same thing. We're going to say this is happening on, let's say 4/15, except we're putting it into a cash account, but we're calling that cash account undeposited funds. Also note that if you're using a QuickBooks specifically software, then they don't actually call it a cash account. They call it an other current asset account, but it's really a cash account. The reason they put it into other current assets is because it doesn't behave like a cash account, and so it doesn't have the same kind of settings you need for a cash account generally to be qualified as a cash type of account, which is really, from a software standpoint, they're designing the account to do certain things for a cash account. Therefore, from a functionality standpoint, it actually works better as an other current asset account. But if you were to kind of group it together, it would in essence be a cash account because it represents holding on to actual physical dollars that hasn't gone into the checking account yet. Okay, so then the other side is going to go to the accounts receivable account. And this is going to be for that 1,400. We're imagining we are getting paid by this now. Alignment indent here. So same thing, except that we're going into a different cash account. So we're going into undeposited funds. That's in H5 equals that 1,400. And then the receivable is going down. So here's the receivable. We're just moving it from here up to the cash account, double clicking on it, going to the end of it, plus we're going to pick up that 1,400 credit, taking it back down. That puts us back in balance. Once again, there's no impact on the income statement and therefore net income at that second transaction, because we're getting, even though we got money, because we recorded the income when we issued the invoice, because that's closer to the point in time we did the work, and allows us to track the receivables with the use of an accrual-based account, which is accounts receivable. And so now let's post it to the GL. So here's the undeposited funds. That's going to be like the second account here, second account. And notice again, in QuickBooks, it might be further down because they categorize it as an other account. But I would, just from grouping standpoints, it should be a cash kind of account. Okay, so this is going to be 4/15. And then on P5, this is going to be equal to the 1,400. So it's going up now, 1,400. And then the other side going to the accounts receivable, the third account over here. Third account right there where all the action's at. That's where the action's happening. 4/15. So we're on, and this one I think should have been 4/10. Sorry about that. And so we're on 4/15. This is going to be equal then left to the wall. And we're picking up then the accounts receivable going down. So here's our trend. We've got the 2,000 starting point. It went up with basically an invoice or work that we did, that we billed or invoiced the client by 1,006 to 3,006. Then we got paid. It goes down when we received the payment by 1,006 back down to 2,000. Then we did more work, invoiced again, billing the client, goes up to 3,004. Then we got paid. It goes back down to the 2,000. This is the trend you would expect to see. In the actual accounts receivable account, it might not be this easy to see, of course, because there'll be a lot of transactions happening. But if you were to sort through the data, it would be increasing with an invoice, decreasing with payments, and you should be able to tick and tie them off, although they won't be right next to each other like this if you had a lot of other transactions happening. On the transaction subsidiary ledger, they will be pretty much right next, very close to each other as we go. So if I go back to the left, let's now post it to the subsidiary ledger, which is all the way to the right. So going all the way to the right till we find the subsidiary, not all the way, but it's way over here to the right. And so now we're on AY6, and this happened on 4/15, and this last one should have been 4/10. I messed up the dates horribly, sorry about that. And this is going to then be equal to, scrolling all the way to the left, and then we're going to be picking up that 1,400, enter. So same kind of activity here. This is what you would expect. 1,000 starting point, went up with, in essence, an invoice, did work, billed the client to 2,400. Then we got paid, bringing it back down to 1,000. The total of the 4 customers adds up to 2,000. That should tie out to the TB, given the 0 here. Let's double check it. The TB being the trial balance. It's not tuberculosis in this case. It's a good thing. It's the trial balance. We like TB. So here it is, the 2,000. So that's going to be the general idea. And then this amount in undeposited funds should represent money that we're holding on to, or money that is grouped in some way, possibly by the credit card company or something like that. And then we're just using that as a clearing account to then either go to the bank at the end of the day, taking all the stuff that we collected, all the cash that we have, and depositing it into the bank in one lump sum, in which case we would then move it from undeposited funds to the checking account in that lump sum, noting that that's the amount that we expect to appear on the bank statement, and we want it to match so that we can reconcile with it. Or if it was like a credit card situation, then we're moving it from the undeposited funds to the checking account in accordance with the grouping that the credit card company is grouping them in, so that once again, it'll show up on the bank statement in the same grouping as on our books. If this was just one single payment that was an electronic transfer or something, and it was going to appear on our bank statement in the same format that of that 1,400, that's when it would make sense, as we did up top, just to put it directly into the checking account and skip that second step, because it will be okay there, because really that undeposited fund is designed to help us to group the deposits to appear in our books the same way as it would on the bank statement. So then if we go all the way to the right, then of course, this information would be used to create the balance sheet. If you were to do this in QuickBooks and the income statement, the financial statements, if you were to do this in QuickBooks, most likely you would enter the transactions, and then you would go directly to your financials and say, okay, there's the checking account, and there's the accounts received, there's the undeposited funds, there's the accounts receivable. We're in balance here, of course. QuickBooks will force you to be in balance. And then I could drill down on, say, like the accounts receivable, which would take me to the general ledger, or the transaction detail report, they might call it. So that would take me all the way to something like the GL, and we'd say, okay, there's the GL showing me the activity. And then you might say, yeah, but I'd like to see that activity by date, and rather, this is by date. I'd like to see it by customer, making another report, which might be some kind of AR aging report, or it might be the customer balance detail or summary report, which would be similar to our accounts receivable subsidiary ledger. Those reports are subsidiary reports to the general ledger due to the fact that the total of them should add up to the same amount on the GL.